This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. Hello, everyone. We are live from the Benzinga headquarters in downtown Detroit. We're live. It is Benzinga. That's why it is called Benzinga Live. It's good to be back after a couple hours. If you tuned in this morning to pre-market prep, I was on and I'll be on again tomorrow, filling in for Joel, who's celebrating his B-Day. We have sold off significantly since I was last on the stream before the market opened. Let me go ahead and pull up my Benzinga Pro and we'll take a look at the market. Let me know in the chat, everyone, what you guys are trading. Let's pull up just the S&P 500 first. Go to a 2-minute chart here. As you can see, we opened up here around 425. And since then have just been trickling lower and lower and lower, now at around 421, 422. So S&P 500 is down about 0.7% today. Let's go ahead and take a look on the weekly chart. You can see 1, 2, 3, 4, 5 red candles in a row here. So things have just not been looking good in the market the past couple weeks. I think a lot of people, and it might take some time, I feel like, because the market, is looking out ahead of time, 6-9 months down the road. Hello, Shelly in the chat, 420. What up, MD? Of course. Miss everyone who doesn't tune in anymore. Anyway, S&P 500. So the market's looking out 6-9 months ahead. We talked about this morning. This means that, the market could be pricing in the things that we're going to see from an economic data standpoint throughout the next 6 to 9 months. And why I think that's important is because basically, look, like if the market right now is looking ahead 6 to 9 months and saying, okay, we expect there to be some sort of an economic downturn, and now the S&P 500 is 10% off its highs. And then throughout the next 6 to 9 months, we get economic confirmation of that. Saying, okay, the unemployment's going back up, all these things. The good news, the silver lining, is that if that is the case, which again is looking more and more like a certainty as, people position themselves for some sort of a recession or an economic downturn, is that should, at least in theory, lead to a decrease in inflation. Now, of course, we'll see if that ends up being the case. But again, just keep that in mind, that if we start seeing confirmation from an economics data standpoint that there is a downturn, essentially some sort of a recession, whether it be mild or severe, whatever, that the market is looking ahead to this, and some of it may already be priced in, essentially, that when you start seeing unemployment tick up, and then at the same time the market's down, it's going to look ugly and it's going to look bad. But again, I think in a lot of cases the market's looking ahead, and right now what you're seeing in the S&P 500 is telling you, yes, we are about to see some sort of economic downturn, some sort of a slowdown, people starting to save more instead of spending. Because look, that's the only way the Fed is going to be able to ultimately get to its inflation goal, is if that people start saving money more instead of spending money more, which has not been the case yet. All right, let's go ahead and get to our first guest of the day. Just to preview for the day, because we do have a busy day, we're going to bring on my man Steve Colian for about 10-15 minutes here, and then we'll be talking to Rob Roy. We're going to talk some options and spreads with Rob, and then we will continue the options conversation and talk to Chris Capre at around noon Eastern. So it's been a while since we've had Chris on the show, so excited to get him back on. So without further ado, with that said, with the busy schedule, let's go ahead and bring our first guest, Mr. Kalyjian, on the show. What is up, Mr. Kalyjian? How you doing?
Hey, Aaron. Good morning. Hey, everybody. Great seeing you. It's been a while.
I know it's good to be back. We've had a few weeks in a row where we've had events kind of scheduled at the same time that the show usually is on Thursdays. So it's good to be back. It's good to have you back. How's everything in your world?
Great. Everything's well. I'm down in Florida here. I love it. And just every single day, just, you know, pounding away, staring at the markets, and really interesting what's going on here. Lower highs you can see from that chart, the July high, and we're at critical levels here. Tomorrow's number is going to be telling, you know. But we had some strong economic news this week. It doesn't look like inflation is coming down the way they want. I mean, I think at one point when the bonds were trading below the 110 level, I think they got down to 109, 20, 30 seconds. You almost had 8% 30-year mortgages. I mean, it was just, these are numbers that people haven't seen in 2 decades, and it's just, I don't think that this is a stagflation type scenario here. And I heard you talking before we got on about how people need to save. Well, 61% of the people in the United States live paycheck to paycheck. We have over $17 trillion worth of credit card debt. I mean, this is staggering, and people are just living on their credit cards and just trying to get by.
Yeah, and I mean, I assume, Steve, I think you've been kind of calling for some sort of, market downturn for, a while. So this has got to be some confirmation for you. I guess where in, realistically, do you see the S&P 500 going? I mean, we're at
this year or like in the next year.
Where do you think in this current, downturn, I'm not going to call it a bear market yet because I don't think it is technically a bear market.
No, it's not a bear market yet.
Where do you think the bottom is? Where do you think we hit and bounce from?
Well, I got buys on the monthly charts except for the Russell. So of the 4 ETFs that still remain bullish are the diamonds, the Qs, and the on the monthlies, on the bigger time frames. If that number gets taken out, you can see the measured move to retest the lows and maybe even make new lows between the 34 and 3,500. I don't think they get any worse than 3,250 if we have a severe recession. But right now, I think the primary thing to consider is tomorrow's economic number. That's going to be telling. If the number is stronger than expected, and if the JOLTS number coincides with what's going to come out, if there's an economic number that's strong here, I think look out below, because the Fed's now really finished. Nothing they're doing is working. Inflation's still high. Food and groceries are up 20%. Things aren't coming down. I mean, I talk to the people every single day. Restaurants have to constantly keep changing their menus for price increases. They're blaming it on the food supply channel. It's not accurate. Everything's going through the roof. So to me, when we were on over the end of the summer, when the S&Ps were towards the middle of the summer were 4,600, I remember my exact words: let them have them. Give it. I wouldn't buy them with your money up here. And they dropped, close to 400 points on the S&P from there. So yeah. I think the ultimate way to look at the market here is, and here's the other thing. Everyone's like, oh, well, seasonal times are coming, So I've been around, 40 years, and, sell in May and go away. I can't even tell you how many rallies blew people away during that time period. Oh, seasonality. I remember a couple of years ago, we got killed in the November, December, So if it was that easy, right, then I think, everybody would just be gazillionaires per se, right? So,
100%. Yeah, it's never as easy as like
no, I've been doing this
those.
40 years, you know? So I think the most important thing is is that I think the way to play this market out is to be in cash. I think you need to you can get 5% on CDs right now, on even shorter 1 or 2 year. You can go out even longer, you get 5.5, I think. And I think what you do is you wait for capitulations in the market where, if we do get some type of lows, but to buy them here, even here, I wouldn't buy them because I think things are that bad.
Yeah, and I mean, I guess what like if there is the expected economic downturn and then the Fed ends up being able to say, okay, we're officially done raising rates, or then they even start talking about cutting rates. I mean, what stocks do you think, what industries do you think come back the quickest? Like what ones would you start looking at if and when you're ready to start taking stabs at some beaten down names?
I'm more of an ETF guy. I believe because I don't have to deal with the earnings every 4 times a year. I think then, if people are looking to buy something, I think the prudent thing to do is to look at the Qs, which will always be my favorite. Then the spiders. The Russell's been in the monthly Russell has been in the bear market since April. I looked at it last night, April 29th of 2022, off my work. So if there is any kind of, I don't like buying names in stocks. I'm not a fundamentalist. I'm a technical person. So I rather look at the underlying ETFs. I don't have to worry about earnings every 3 months. I mean, I don't have to worry about a company coming out and downgrading a stock or upgrading a stock or whatever. I think the ETFs are there for a reason. I think they're a great vehicle to trade.
Got it. Yeah, and that makes sense. Well, all right, Steve. Any other thoughts on the markets? On
No,
anything?
I think tomorrow's a big number. You got to wait. You can see the markets are dead here, and it gives me the opportunity to come on. And nobody's going to do anything until until tomorrow. 8:30 is going to be a critical number. If it's a strong number and it coincides with the jolts, I think the markets can have some technical difficulties here.
Yeah, and I mean, we've kind of been this 420 level we're at on the SPY. I mean, I remember we were, trading at this April 2021, I want to say. I mean, this has been here, look at it on the weekly. We'll check. Back in May 2021, April 2021, we were at SPY 420. So we've basically round tripped now 2.5 years worth of chop, up, down, up, down, up, down, and we're back where we were 2.5 years ago.
I mean, I don't think this is going to end pretty. I think you're up 10% on the S&P year to date. I think you try to shift the drop. I think you try to get involved in the underlying ETFs. And if you think the market's going down, you got reverse ETFs like the SDSs, the SQQQs, things like that. But to me, I think the most important thing is, I would be on the sidelines and I would get more clarity as the economy. Yeah, I mean, down here, people in Florida are only buying houses for cash. Nobody's buying houses with mortgages.
100%. Yeah, the housing market will be one to watch as well.
Yeah.
All right, Steve. Well, as always, great to have you on. Looking forward to getting a chat next. And yeah, good luck in the markets. They're kind of crazy these days.
Yeah, it's what you love. As you love volatility, right? So
yeah, as a trader, you gotta love it. Gotta love it. All right, man. Take care.
All right, brother. Have a great one. Have a great weekend. Thanks, everybody. Be well.
You do the same. All right, guys. That was Steve Colian. And yeah, always good to hear what Steve has to say on the markets. Like I said earlier, we've got a busy show. I've got my man Rob Roy hanging out backstage. We'll bring Rob on in just a minute. But yeah, taking a look, let's go down back to our 2-minute chart here on the SPY, see what we've been up to. Looks like the S&P 500 is starting to kind of maybe find a bottom down here of the day. We'll see if that holds. We'll see if we make that confirmation to the downside or a reversal and come back up. But I've been looking. I saw this headline on CNN inside plant trying to keep up with demand for weight loss drugs. So they're inside, I assume, the Eli Lilly and Novo Nordisk's plants. Also saw another Ozempic related headline that Walmart said that people are spending less in the stores because of Ozempic. I mean, that was something that people have talked about, that this could be bad for vices like gambling and all these things, that Ozempic helps curb those urges. But I figured it was going to take a lot longer to see the impact of those things, if at all, throughout the economy. Maybe Walmart's just not having a great quarter and looking for something to blame it on. Who knows? But all right. Let's go ahead and bring Mr. Rob Roy on. It's been a few weeks since we've gotten to talk to Rob. So without further ado, the man, the myth, the legend, Mr. Rob Roy. Rob, how you doing, man?
Aaron, how are you?
I'm good. Good to have you back on the stream. It's been a while.
It has. It's great to be back. Thanks again.
Of course. Thank you for taking the time to join us. So, what's new? I mean, the markets have kind of changed a lot since I feel like the last time we've spoken. What have you been looking at? What's your current market outlook? Are you as bearish as everyone else is?
I am. I actually did a training with one of our coaching groups last evening, and we talked about this exact thing. We went through the S&P, the NASDAQ, the Dow, and the RUT to look at what their pullbacks were from their 52-week high, where we were sitting. And ironically, we see that we didn't hit correction territory yet. We're about 7.5% on yesterday's closing prices, right around there, with the exception of the RUT, where we're about 14%. So almost double on the RUT where we are with all the other indexes total. So we're looking very closely, watching out for, you can see on my screen here, let
me go ahead and pop that up. There you go.
Perfect. Thank you. We're looking for the pullbacks and to where, right? So we've got a couple of key levels in place on the S&P. The first one is we've got these lower highs and lower lows that took place. We've got our lower highs here, right? We've got our lower lows setting in place. And for 3 days now, we have pinned off of this 42.1680, which was the low price on Tuesday. We've come right down to it this entire week, right? From Tuesday, Wednesday, Thursday. And we've got to watch that level first. We break through that level. The next thing we're looking at is there's a fib line at 41.85, but much more importantly than that, Aaron, there's a confluence of 4,181. That is a Fibonacci line. If you use a Fibonacci number series, that 41.81 is a critical level. And if you go back historically, I can share it, but it may be a little bit busy. It's a weekly chart. You can see how many weeks we lived here and here, this black line, 41.81. It's a critical level for us right now of, are we going to make it back to that or not? I've been calling it since about this gap down. I've been saying that we're there because we broke our overall uptrend, right? Lower highs setting in place. That gap down set it up. Strong gap down, strong continuation on the gap and go. And we've just not looked back since. Small retracements back up, but nothing that says, ooh, buy here. And that was a big contention last evening. We do have some people that want to try to get in early. And I'm not a get in early type guy. I'm going to get in when the signal is clear. I may test the waters with a very, very small position, but I am not betting on, ooh, this is the bottom and we're moving forward. So I really see some opportunities as we bottom out here, because it's not only the 41.81 that we're looking at, but we need that 10% correction, which takes us down to 41.46. So those two levels right now are of utmost importance to me when we're looking at the S&P. And we do the same exact thing on all the indexes, but primarily the S&P and the NASDAQ, because those are the ones that I at least tend to trade most.
So it sounds like you think that there's going to be at least another slight dip before the market starts to bottom out?
Unless something crazy happens with numbers like tomorrow with all the unemployment stuff, unless something happens there, yeah, I don't think we're done. It seems that we try so many days, we get this gap up, and then just like today, we get this gap up and we fail right off of it. The bulls are trying. The bulls are doing their job. The traders are throwing money at it. They're stepping back and watching, but it just can't sustain. The bears are taking back over, and it's just not letting it happen just yet.
And I assume that, you'd think the market would respond better tomorrow to worse unemployment, that, like if the unemployment number goes up higher than expected, that the market would respond positively to that.
That's what I would expect. But sometimes with what I see happen with reactions to markets, they're not like they used to be. This is not your grandfather's stock market anymore. It's a heck of a lot different today than it was. I mean, I'm doing this for almost 27 years now, and I've not seen anything like it. I've seen bear markets, plenty of them, but nothing where it's this much of a fight. You look at the debt we're going into as a country. Credit card debt is at near all-time highs. Savings is down to pre-COVID, where COVID gave a big savings opportunity for individuals to put some money in the bank. We're seeing all of these things kick in. People can't buy houses. They can't buy cars. Everything's too expensive. You got big names out there, the Robert Kiyosaki's, the Grant Cardones, screaming that the housing market's going to come and crash. These are people much smarter than I am when it comes to real estate. I've got my share of it, but not what these guys have. I don't own many 350 apartment complexes. Not many, like some of these guys do. But overall, we look at what's going on. I would expect to see the market rally from it, but it really comes down to what the forward-looking statement along with that is. Yes, it was good numbers or bad numbers, but the Fed is still out there. And now I think Waller speaks tomorrow, right? At 12 o'clock, Waller comes out and says, oh yeah, but we've been talking and, not looking good.
Yeah. It's just so interesting because everyone, it seems like you said, like prices are still high. Inflation seems to be hitting everyone, but yet the average consumer hasn't really at least started to make that shift towards saving from consuming. And I think that's what's going to end up, helping drive inflation down. Obviously, we're going to get wage growth numbers tomorrow. That's a big part of inflation. So I think the Fed will be watching wage growth. But unless, the unemployment's some crazy low number tomorrow and the economy looks like it's still running super hot, the Fed's Jerome Powell's pretty much said they're done, not completely finished raising rates, but maybe another 25 basis points from here, but probably not anything higher, at least in the foreseeable future. So then if the Fed's not going to raise rates much higher, where's the fall from inflation going to come from? How are we going to see that shift towards saving from spending when right now the economy seems to just be ticking along like normal? Doesn't matter where rates are.
Yeah, sooner or later, unemployment is going to kick in, and we are going to see the numbers get higher. The fear is still, do we get into some sort of recession? Some say we've been there. Some say we haven't. I don't think we have. But right now, the numbers just don't jive with what we're seeing happen. We should see some unemployment numbers kicking up, and we're not. Right? I'm surprised it hasn't happened along the way. Listen, I get it. There's people wanting to work, and there's a lot of jobs out there. The economy is great. Everything is running and rocking and rolling. But we cannot sustain on this path forever. It's impossible. And I'm not sooner or later we're going to go back down, or sooner or later we're going to go back up. That's not me. I'll pick a direction. Right now, the way that I look at markets, Aaron, this is a bearish market. We're in what I call a true bearish bias. All the moving averages are in the right order. The pink is on the bottom. That's our 8. The green is in the middle. It's a 21. And the red is on top. It's 55. That's a true bearish bias. We're below that moving average. The moving averages are spreading apart, both the pink and the green and brown. So there's strength behind that number. The ADX, and we're looking at S&P here. The ADX is at 45. The DMI minus is at 31. So everything is pointing to down. We have nothing yet that says shift in the other direction. Could it happen? Yes, but I'm not the one to jump on that bandwagon. Almost every trade we have done in the last month has been bearish. I think we did one bullish trade, and we did it with a smaller number of contracts.
Yeah, 100%. And so the numbers tomorrow, the unemployment, I mean, the expectation last month, or I guess 2 months ago, so we're going back to August, was 3.8%. For September, it's actually supposed to fall slightly to 3.7%. So I don't know. I'll be curious, because even if it just comes in line with that expectation, it'll still, the headlines will still be that unemployment falls month over month, and it'll be interesting to see the market reaction. But I just, it seems like the economy overall is, at least right now, doing well. And that's been the case, I think, doing better than expected throughout the last year. And that's why interest rates are where they're at. So I feel like people keep talking about, oh, rates are this high and they're the highest they've been since whatever, talking about them as if the rates are not, the rates are a byproduct of the economy. The economy's been so hot, so rates can be up at 5%. If the economy hadn't been doing so well, there's no way the Fed would have been able to raise them this high. And you also wouldn't have seen inflation persist. So I feel like you need to kind of keep that in mind too when talking about the rates, that the only reason the rates are this high is because the economy has been very, very, very strong.
I agree. It's all because of economy. We've got more people in the workforce right now, more jobs, and people looking for jobs. I mean, that's always a key sign. There are rumors, or not rumors, but whispers of we're going to start to see some pullback in numbers. Numbers being wage raises, wage increases are going to have to settle in, right? Rent. There's talk of rent easement as far as what people are paying, or what they're going to be able to ask for. It's up way too high of what people can actually afford. And I mean, I see it with the tenants we have in the various properties here in New York and Florida, various locations that we have. We've got tenants that are, good tenants. And when they tell me they're struggling money-wise, I know they're struggling money-wise. So, and we don't raise our rent. We have a good tenant. We are the landlord that doesn't go crazy and say, all right, we're going to hit you with an 8% increase this year because that's the cost of living. We go ahead and say, you know what, we're going to raise you $50 this year. We're going to raise $70 this year, which is 3%, 4%, usually half of that to 3/4 of that number of what people are looking at as far as everybody else is. So our tenants are definitely under market, but we've got good tenants, and we just don't see the reason to rock that boat where I've got to jump on an airplane and go to Florida to try to fix a house that someone destroyed because we had an idiot in there, so we can get an extra $100 a month out of them. That's my philosophy anyway when it comes to it. But we see these tenants dying that they just can't afford to pay rent, and we're well underneath the market value.
Yeah, and I think, and I've started to hear anecdotally from, my friends and stuff, that people are saying, oh yeah, I spent a lot of money this summer. I'm going to try to save some money and, pay off credit card, whatever it is. And again, I don't, at least right now, to me, I'm not freaking out about the market or some big recession, because I think it's all kind of calculated in that sense, that the Fed wants that. The Fed wants there to be some sort of a cool, they don't want, an 07, 08 type recession, but they'd happily enjoy a few months worth of people spending a little bit less. And then that helps drive inflation lower. And, ultimately, you can't just, like you said, you can't just run hot forever, and it's not sustainable. So you're going to need to cool off when you need to. And again, I'm not that worried about it, because I don't think, I guess in the sense that obviously any sort of economic slowdown or recession is bad, but not necessarily unhealthy overall, in the sense that I think that's what the Fed's looking for right now, and might help us get to a little bit of more certain times, because there's just so much uncertainty right now. At least if we had the certainty of knowing, okay, yeah, the inflation's coming down, unemployment's going up. Okay, then we know that, and then we know the Fed's going to be close to cutting at some point. But right now, there's just so much uncertainty about what the Fed will do, what the Fed is able to do. So, again, I haven't started thinking the sky's falling anytime soon. So I think the market's just kind of pricing in what's going to happen over the next 6 months to a year, which is probably some sort of a slowdown, but nothing crazy.
Right. I agree. You look at, I heard your comment with your last guest, where you're talking about Walmart. Is it Ozempic that's caused it, or is it people are starting to say, you know what, I just can't afford some of these things I would like to have bought, and I'm going to hold off. I'm going to get a haircut every 5 weeks instead of every 3, or I'm not going to buy the more expensive coffee. I'm going to buy a bag of coffee and make it at home. We see it in, my wife and I have a restaurant that we go to usually every week. It's a family-owned local restaurant, little hole in the wall with amazing food. And you go in there on a Friday night at 6 to 7 o'clock, and you're waiting a half an hour to get a table. And we walked in last Saturday, and there were 3 empty tables at that time. So we see it, I see it, that there are things happening that I think people are just pulling back a little bit and trying to see where they can cut, conserve, reserve, whatever word you want to use for it, and just be cognizant that the uncertainty is there. It's great that workers have the upper hand right now because there's more jobs than there are people. But at some point, it's not going to be the case. And there are going to be some concerns of losing jobs and all of that. So those are the individuals, many of them, that are living day to day as it is now. What happens week to week, at least, but what happens when they lose that job and there's just no way to pay any bills at all?
Yeah, I think that's, that's why when you start having a lot of people, Andrew Yang and people like that talking about, once AI starts taking over a certain amount of jobs, there's going to need to be some sort of type of universal basic income or something along the lines. Cause like if every type of, big major corporation, whether you're talking about Walmart, McDonald's, UPS, FedEx, these corporations that collectively employ hundreds of thousands, if not millions of Americans, start automating these jobs, then like what's going to happen? And you're just going to have all those people with no jobs and no money, so it's people are raising that question of what is going to happen. So who knows?
And we've seen it for a while now, right? As wages have gone up through the years, you look at places like McDonald's. My wife worked in McDonald's when her and I dated. We started dating in 1985. She worked in a McDonald's at the cashier. They had 4 or 5 cashiers every time you went in there. Today,
is that how you met? Were you ordering a Big Mac?
No, I don't eat McDonald's, but never really did. But it was a blind date.
Okay.
Our blind date was at the San Gennaro Feast in Manhattan. Our best friends had set us up there, but she would work there, and there were 4 people on cash register. Now you go, they've got kiosk and 1 person on register. And I saw one location now, whether it was a test or they're rolling it out, that the drive-through window opens up and it's a conveyor belt that brings your food to you.
Wow.
I
haven't seen that yet.
McDonald's, companies like that have no choice. I don't know. My opinion of McDonald's, it is not for most people, it's not a full-time job that you're supporting your family off of. $20 an hour is tough, which is where we're at in California right now. They just, Newsom just made a big deal that was that. I saw an interview with him on one of the news channels. But you're going to have companies like that have to offset. AI is just that continuation of it, where you're going to see those things happening. I look forward to it for our business, right? That we can find some faster ways to do things. We use it now already in what we do, and it's been a big help. So, but there is the Terminator type movie of machines taking over the world.
Yeah, it is crazy. There's just so many different things that I feel like are going the way of AI, and it's just going to happen quicker and quicker. And then it's going to be like you blinked, and then you look around and you say, "Holy cow, what happened?" But all right, Rob, it's I do got a jet because we've got another guest lined up. But it's great to get you back on. I know it's been a few weeks, so I'm gonna go ahead and drop the links in the chat. Or what do you want?
TradeLikeABoss.com, guys. All of our free content is right there. All of the resources to help you become a better trader is right there for you.
Beautiful. All right. Well, dropping that in the link. Rob, thanks as always for hopping on the show. Hopefully we'll speak next week.
All right. Take care. Thanks, Aaron.
Of course. All right. TradingLikeABoss.com. Check it out. I don't know. It just reminded me of when we were talking about AI. Just real quick, because I don't know. I'm not really in the camp of I'm super worried about in the next 5-10 years, AI is taking over everything and people don't have jobs. I know there are people like, especially like I mentioned Andrew Yang and other people that speak about the types of issues that could arise from AI coming up. But I think it's important to note that, like, going back, people have always said this about new technology. Going back to the like industrial revolution, people said that about machines coming in. They were like, this is going to take over people's jobs. People aren't going to be able to make money anymore. And what happened was the machines led to more economic activity, which led to more jobs. And then, like 100 years later, the same thing happened in the 60s and 70s when computers first started coming out. People said, there are newspaper articles you can find from the 60s and 70s, people saying, oh my God, these computers are going to take everyone's jobs. Or all these jobs are going to go away. And then same thing happened. The computers led to more economic activity and more jobs creation. Now, will that happen with AI? Probably a little bit of both. I mean, you will probably get some, economic growth from AI that will lead to more money and lead to more jobs, but maybe it's the far end of the spectrum, and now the technology is too good where it is doing a lot of, I don't know. I mean, it'll be interesting to see, but I wouldn't be like, Chicken Little, the sky is falling about AI right now, because if history has told us anything, it's that the opposite is true, is that it leads to better opportunity, that technology has led to better living conditions, people being able to work less, at least in terms of like manual labor over time, as opposed to working more. So yeah. Fed's daily comments, watch that TLT. So let's check out before I bring on my man Chris Capre. It's been way too long since we've had Chris Capre on the show. S&P 500, we're looking at a 2-minute chart here. It looks like we're just kind of chopping up a little bit. Let's go over the TLT. 2-minute chart here. Yeah, wow. Came back hard from this morning, TLT did. All right. Let's go ahead and bring Chris on. Let's give Chris a very special Zinger Nation welcome. And when we come back, when we come back, we'll still be talking about TLT. A little bit of TLT inception there, baby. All right. Let's give Chris that special intro. Mr. Capre, how's it going? It's been too long.
Very good. And yourself?
Pretty good. Well, I mean, I guess the markets could be better, but I'm doing well. I mean, outside of that.
Glad to hear. Glad to hear. The hair is doing well, I see.
Yeah, I need to go get a haircut. I'm gonna try to either do that today or tomorrow, because I'm supposed to see my mom this weekend for the first time in a while, and I feel like she'll be mad if I see.
Oh yeah, make sure you're looking dialed up when you see your mom.
Yeah,
otherwise,
exactly.
You'll make her worry.
Exactly. All right. Well, what you want to go ahead and share your screen? I heard you were talking some TLT in the backstage, so maybe we'll continue the TLT conversation.
Okay, let me pull up the screen. Okay, you should be seeing my screen now on TLT.
Yep, got it pulled up.
Okay. So for those of you that haven't heard me before, so I'm the lead instructor at the Benzinga Option School. And my whole approach is that I don't try and make interpretations on what's going on economically or people's responses to numbers or what they think the market should be doing. Are we in a recession? Are we not? My job is just to look at the flows. That's all I do. I don't really care whether people are bullish or bearish. I don't really care whether people think that it's rates, or the reason why we have high rates because the economy is good or because there's asset inflation. I honestly don't care about that, because the bottom line is that those people have to eventually make a buy and sell order. And that collective buy and sell orders is what's going to drive the market. The most dominant, the most proximate driver of price action is order flow. And I particularly focus on the options market because options has you got to think of options as kind of having these levers that if volatility in the VIX is really high and that lever comes down, then that creates a tailwind for equities. if there are a lot of long puts in the market that are expiring this Friday, then when they come out of the market, that creates less pressure on the markets. And so I just want to look at the flows and see what's going on with that and where are traders trading right now. And I totally agree that right now it's all about rates and yields. We've been saying this in the Benzinga Option School for days now, saying, hey, the number one driver right now is rates and yields. And TLT being at multi-year lows, something we haven't seen since, 2011 or even below that, actually 2007, 2008. If you have volatility in the bond market, you're going to have pressure on equities. You're going to have instability in equities. And that's what we have right now. You were saying, hey, the market's bearish, but I'm not too worried about it. From the options market, I'm not seeing a whole lot of worry either. Yes, we do have a somewhat elevated VIX for sure at 19, but we haven't seen a VIX close north of 20 in months, 6-7 months, right? So, and I don't see traders panicking. If I was to kind of, draw out the term structure of say today, Friday, we have NFP this Friday, and then we have some events next week. I see a little bit of elevated term structure, but then it kind of flattens out after that, right? And so traders have mild concern, but the bottom line is they're not panicking. There's not fear in the markets. And that's why, we're not seeing VIX spikes north of 20. That's why we're not seeing the S&P really, kind of sell off in any liquidation type scenario. We have some good intraday probes where S&P could be down maybe 1.5%, 1.25% on the day, but it's not closing at those lows. We're always getting that kind of late day bounce. And so I think, what's really going on in the market is we're in a negative gamma environment. That means that volatility will be slightly elevated more than usual. There are traders that are willing to reach for some downside protection, but they're not too worried. In terms of the options market, there's more puts than calls, that's for sure. And there's definitely a lot more long puts than short puts. But, I'm not seeing them go deep well beyond, these current prices. By my calculations, the top put strike, which is kind of if you were to look at the highest concentration of notional gamma and notional open interest in puts, for us, that is, right at basically 420. And it's not surprising that has been kind of a floor this week. We've, been telling people in the Benzinga Option School, look, for right now, until we see this kind of TPS, which is kind of right around here, until we see that roll lower, we would expect the market to be somewhat, if it gets here, it consolidates or bounces. We don't expect massive bounces. We don't expect a bull run or anything like that. But we feel like that's the downside target. That's what bears are targeting for the week. And so when I look at that, it hasn't changed over the last 3 sessions. So I don't feel like traders are saying, wow, we're really worried about sub 420 prices. We're going to start reaching for 415, 410, 45. I'm not seeing that. So we've been in the Benzinga Option School playing it very simple. Sell rallies for weeks now. If we want to get long, we get long in alternative tickers. UNH, crowd, things that are not quite as, kind of subjected to the pressure of rates that say certain tech tickers would. Obviously Amazon and Tesla and, the Meta and Microsoft. Tech is asymmetrically affected by rates than, other tickers. So if we move outside of that, then we're not as affected by that. So that's kind of how we've been playing it right now. And that's kind of what we're seeing in the flows of the market. It's kind of mirroring what you said. There's worry, but there's not panic or anything like that.
Yeah, and I mean, we saw, I think the VIX spike up, was it last week or this week? Just a little bit higher, but, still was higher back in March when we saw that regional banking crisis. What do you think? I mean, with the VIX now, do you expect it to continue to come back down? Do you think it'll spike back up? I mean, what are options traders betting on this?
Yeah, so if we look at say XLF, I don't see traders getting heavily long XLF right now. Hold on, let me just kind of pull up what I see in positioning. I see the majority of XLF traders kind of position between 32 and 40. So they're expecting a little bit of a rally between, here in the OPEX, but I'm not seeing them jump hand over fist to buy calls right now. Financials, I think, are going to be a little bit vulnerable right now. So, and we're not seeing option traders say, hey, this is a gangster buy, we want to get long here, or anything like that. Quite the contrary. So we've seen a little bit of mild call buying today, like a decent amount of call buying. And we have seen some traders sell some long puts. So if you think about it, if the market is like long puts, right? You got a long puts, and then they start to close some of that, then that relieves pressure. So if they've been long puts this whole way, and then they start closing these, then you kind of get these little pullbacks. And you kind of tell, the price action is kind of revealing that it's not ripping, right? It's not like traders are falling over themselves hand over fist to buy calls. They're just closing a lot of the long puts. When you close long puts, does that generally create a rally? Yes, if there's a lot of long puts on the board, that's that lever action of options. You close the long puts, it creates a little bit of tailwind for equities, but they don't create sustainable rallies because closing transactions don't last in the market, right? Closing a long put is going to have a different effect on a stock than buying a long call. The long call is staying in the market, and they can often be support on pullbacks if you have enough long calls. But those long puts, once they're closed, they create a little bit of a relief. But the bottom line is that they don't offer support on pullbacks. And that's why we say, hey, sell rallies, is because a lot of the bounce that we've been seeing have been more the closing of long puts than they have been of buying long calls. And so with XLF right now, we don't see any reason to get long at these prices. Do we think it's toward the oversold boundary? Yes, we think it's pretty close to oversold. We think around 32. From a positional standpoint, it starts to get oversold. We don't look at RSI for oversold or any sort of indicator really that. We look at the options position. Where is everybody stacked? And is there enough interest below current prices? If there is, then we don't think it's oversold. But if nobody's reaching below those current prices, then we think the market is oversold. So we think we're kind of getting close to that. We're not there yet, but I'm not seeing traders, fall over themselves to buy long calls right now.
Got it. And why, why would you rather be selling options when, I guess, if the market's going down, you would want to be, the VIX is expected to go up in that scenario? Yes or no?
So the historical numbers are basically over the last 10 years. If the SPX closes up on a day, about 79% of the time the VIX is going to close down. So it's a strong correlation, but it's not automatic. We've had many days this year that VIX up, stocks up, VIX down, stocks down, and so you have to understand that VIX is not like an automatic lever. It's not like this perfect relationship where one goes down, one goes up, because you got to look at how VIX is priced. How is VIX priced? Based upon out of the money options, roughly 30 days out on the S&P 500. So if traders are bidding up that deep out of the money puts, then you're going to see VIX rise. So that's kind of like a sign like, hey, VIX is spiking because traders are kind of worried. And so they're buying these out of the money puts, and therefore VIX is going higher. But you can have plenty of scenarios where you could have VIX up and then traders are still worried, or you can have stocks up and VIX up because traders are worried. And as we're kind of going back up into a resistance level, traders are worried that this sucker is going to sell off in the near future. So they're buying out of the money protection, hence VIX goes up. So, right now there's concern, but there's not panic, and so the good thing about VIX being high is that if we start to see some of that volatility in bonds and yields subside, then we'll probably see some of that heavy vol pressure start to subside as well. We get a little bit of a tailwind in the markets. And combine that with negative gamma, it just exacerbates the moves. So volatility coming down in negative gamma has stronger moves than volatility coming down in positive gamma environments. So it's important we understand the difference of the expression of that is different.
Got it. And then as far as individual names right now, Chris, are you seeing anything unusual in the options market?
Nothing too crazy. Yesterday for our Benzinga Option School members, we were talking live during our, live commentary class saying, hey, You know, like we had a trade. The Tesla was hitting 257 yesterday, and the flows are very strong. Actually, we were saying live that when this breakout was happening, we're like, hey, traders are buying calls and they're selling puts on this. This thing's got room to run. And when it hit 257, we didn't see a slowdown in them buying calls, and hence you got a late day run on that. We're not seeing the same kind of jazz today in Tesla as we did yesterday. Like I'm seeing a little bit of a pickup over the last hour and 20 minutes. Let's see if that kind of correlates with this bounce. Yeah. So about in the last, since this bottom here, actually a few minutes before candles before this bottom, we started to see traders start to load up on buying some calls and selling some puts. It's not gangster like it was yesterday. Like yesterday was much stronger, but it's significant to where like, okay, this rally has a little bit to go. So I'm not seeing any cooling in that. And so, you know, when I see that calls and puts are moving in sync, meaning traders are long calls and they're selling puts, and then I see the price action fall, then to me that suggests that the options are driving the price action. If calls and puts are moving in opposite directions, then we got a mixed picture. So I'm not seeing traders like, you know, kind of fall over themselves to get to any particular ticker. I think they're willing to like be bullish for a day, maybe a couple days, but I think, you know, the overall trend has been down for weeks. So I think they're a little bit worried about holding positions, and rightfully so. You know, in the S&P 500, on any given day, 51% of all options are 0 DTE. That means that institutions and hedge funds are actively day trading the S&P 500. And so if that's happening, then you really don't want to be holding a whole lot overnight. You know, or if you do, you want to kind of choose tickers that aren't as affected by rates and yields. So, you know, UNH has been doing pretty decently lately. That's why we've traded UNH recently. Crowd has been pretty strong this year. They've been relatively unaffected by rates. Like if you look at the chart on Crowd on the weekly chart, I mean, it's just been pretty consistent. You know?
Yeah,
So,
I'm
look
pulling
at
it up
this.
right now on my. Yeah, I mean, Crowd and United Healthcare have both been pretty strong. It looks like. So what do you think? I mean, I know rates coming down is probably like the easiest and right answer, but like, what else do you think will the markets need before you start seeing some more kind of crazy option activity in certain names, or people going super long again? I mean, like, it seems like any sort of rally we have just dissipates and is gone by the next day.
Yeah, that's partially a function of the 0 DTE. So if you think about it, like one of the strongest or the most consistent trades we've seen in 0 DTE options from the institutional side is selling puts, selling volatility. So if I was to pull up SPY right now, let's go ahead and do that. You know, we had actually said this live during our call on this several sessions. But we've had several sessions where we said, like yesterday, what was it? This was Wednesday session. We were saying live, you know, during the morning, like it's selling off. And we're like, we don't see a whole lot of pressure, you know, like traders loading up on long puts and selling calls, you know, hand over feet. So we feel like a lot of these things are going to rally, you know, towards the end of the day. And the reason being is because early in the day, you tend to see traders get long directionally, long calls or long puts, but they don't hold it that long, right? If 51% of all trades in the S&P 500 is a day trade, they're not planning on buying in the first moment of the day and selling at the end. They're trying to get a little bit of, you know, they're trying to get a little bit of delta and gamma if they're long on the direction. And if they're going to sell the volatility, then they're just hoping for a bounce and a little bit of fade on that. And so we've seen a lot of activity where, you know, the SPY starts to rally because traders were selling puts. Selling puts does create a rally, but it doesn't last. It's not the same as a long call. So if traders are selling puts on the day, yeah, you're going to get a bounce in SPY. But if it's 0 DTE, then those effects are coming out of the market really fast. And so I think traders are happy to be, you know, directional for a day or a few hours of a day. But in this environment, especially after the last Fed, I think it probably caught some traders by surprise. You know, before the last Fed meeting, they were planning on cutting rates in June. Now they're like, September, you know, and then they're like, we were planning on, you know, cutting 100 basis points. We're probably going to cut 50. So I think traders interpret that as like, okay, this is going to be rates higher for longer environment. And so because of that, we don't want to be, you know, piling in equities right now. Do I think there's a chance for a stealth rally in the next, week or two or something like that? Yeah, I certainly think there is. The levers are there, and just like a seesaw, if it gets high on one end, it doesn't take much to get it to the other end. And so I feel like VIX being high, it's high enough that it could cause a 5-point, 8-point, 10-point rally in SPY. The negative gamma environment exacerbates volatility. If you were to get those combined with a subside, like a relaxing of the pressure on rates and bonds, then I could easily see a rally up to 440. But I wouldn't expect it to get much beyond that based upon positioning. And to be honest, I've been telling my traders, I'm like, hey, we're not going to really start looking at getting long SPY until we start to see closes above, this 430 to 433 zone. And let me kind of show you why. So there's a fair amount of positioning, option positioning between here and here. And it's not just something that like option traders aren't just piled there because it's lining up with the technicals. It's just, this is where they happen to be positioned. Sometimes option positioning lines perfectly with technicals. Sometimes it lines partially. Sometimes the technicals make no sense in relationship to option positioning. And that, if you understand option flows, that makes sense. But the bulk of kind of where the positioning shifts from being puts in control to calls more being in control is in this zone. Once you start to clear out this zone, then puts are no longer the dominant force. It starts to become calls at that point. And so that's what I've been telling our traders. If we clear that, we're happy to start getting bullish, on a swing trading basis. But until then, we just don't want to. So we want to sell rallies. And that's the theme we've been telling our traders left and right. Keep selling rallies.
Yeah. And, something I'm curious about, Chris, is back when, when we saw the short squeeze back in, what was that, 2020, 2021 at GameStop and everything. I mean, we talked a lot about, short squeezes and why that happened, which you won't ever really see with, just the overall market. But what you can see are some sort of kind of like short covering rallies sometimes in the SPY and other things if people get way over positioned to the short side. And then the markets either, rally, or sometimes they don't even really need a rally. They can just kind of stay where they're at and people need to start covering their shorts. How much, like, what's like the weighting? What's the percentage of people that need to be short for that to happen? And where are we at now?
All right. So let me just kind of pull up some data right now. So on the SPY, the net open interest right now on the call side is about 7.24 million options roughly. On the put side, it's about 12, right? So, there's still more put open interest than calls right now. Generally, in terms of the way I look at it is not so much a percentage, because percentages are kind of relative to the time period, right? So if we think about the number of options that was being traded, say, in 2020 as comparison to now, there is no comparison. We have 0 DT now. We didn't have 0 DT in SPY back then. So we have, more turnover, but I don't look at it as percentage. I look at it as more as like, hey, where is the bulk of positioning? Or another way to put this would be like this. Let me show you in the Benzinga option school. So think of it kind of like this. So this is something that's available to Benzinga option school members. And this is showing all options in the SPY across all strikes, all expiries that exist in the world. Every option in the universe is the consolidated open interest, right? And you can see, what was I saying? And so let's take out price here for a second. And so what was I saying? I was saying, hey, once you start to get above this kind of 430 to 433, this is where puts are no longer dominant. Below this, puts are dominant. Once you start to get above this, you see how the put interest gets smaller and smaller and smaller and smaller. Those would have to be deep in the money puts that people are holding, but those are 1 delta puts right now, right? So, I look at it more as a function of where does the positioning change from, say, like negative gamma to positive gamma, and where does the positioning change from when puts are in control to where calls are in control? And so, in terms of, percentages, it's going to be relative to how many options are present at that time. September, we had a lot of options. You have quad witching. You have the JPM collar that's being rolled. There's a lot of things going on. September so far has been the biggest OPEX this year. October is large, but it's not as huge as September. So you'd have to look at it relative to the time period as well. So yeah, that's kind of how I tend to look at it, is that when we start to get above that place where calls are in control, then that's where you could start to see some stealth rallies.
Yeah. Okay. So I mean, you're looking at it. I guess I'd be looking at it, or I was looking at it the wrong way, where I was thinking, okay, if there's so much outweighted puts, then you might see a rally. But you're saying you'd rather wait to see the calls actually, before you get confirmation of that rally.
That allows the market to be more sustained, right? Because then the calls are driving it, and so if you have long calls driving a market, that's a 10-point rally driven by long calls is going to be different than a 10-point rally driven by long puts being closed, right? Because one transaction is coming out of the market, which is the long puts being closed, and they do so via short put. But once it's gone, the effects of that are gone. The hedging impacts of that are gone very briefly. But a long call, if you think about it, if the markets are long calls, then the dealers are short calls, right? So the dealers, how are they going to delta hedge that? They're going to be buying shares in the market. They have to have shares in the market to offset and delta hedge their position. Once a trade is closed, they don't have to delta hedge that anymore. So closing of long puts does create a rally, but it's not sustained because there's no delta hedging impact to support it in the market, and there's no calls that are offering support. But when you have a rally that's initiated by long calls, where calls are in control, well, then those calls do become support, and there are hedging impacts associated with that. So that's the difference. That doesn't mean we can't get a rally. If the market stalls here long enough, the decay will eventually start to become a problem for traders. Let's say you're long a put. Let's say you got a long a put here, you got a long a put here, and let's say you got a long a put here, right? If the market's here, all of these are making money, but that theta decay is coming out every single day, and that theta monster gets bigger as time goes on. So eventually, that decay overwhelms the gains that they have, and so then traders start to relieve some of that pressure. Sometimes rallies can start just from, hey, we got a lot of long puts coming off the board, and so the decay of that, these would be like charm effects from that, and then Vanna would be implied volatility coming down, and so the hedging impacts from that associated with that allow the market to rise. So that's kind of the main thing you have to understand, is that there's the positions of where calls are in control, but then if the long puts just grind nowhere for the next 2 weeks, like if the market just does this for the next 2 weeks, you're going to see a lot of long puts come off the board because they're not making anything off their money. So those options are just degrading.
100%. And that makes a lot of sense. I'm glad we talked about that kind of from like the overall market perspective, how people are positioned either on puts or calls. And I think, you're seeing, of course, as the price comes down of the market, that, people are becoming more and more bearish, which is usually what typically happens. We're simple people, Chris, really. If the market goes down, people start feeling worse about the market. If it starts going up, people start feeling better about the market. Go figure, right? Well, all right, Chris, we are running a little past 12:30 here. Is there anything, you kind of just want to speak about the Benzinga Options School, what you guys do, maybe a little bit?
Yeah, so I'm live every single day for an hour with my students, 5 days a week, Monday through Friday. Not just in a live classroom, but I'm also live in a chat room as well, kind of giving day trading comments and saying, hey, here's what I'm seeing in the flows. Call pressure is easing on this. Call buying is, increasing on this. This breakout should sustain. And, it's an awesome opportunity for traders to come together, share ideas on the market, and get their trades analyzed in real time. So when my students are not looking at the same tickers as me. And so when they have trade ideas, they just say, hey, Chris, I want to buy such and such bull call spread or a long call on this. And then I take my fancy big brain hat and I start analyzing the market for them. And I kind of, say, hey, here's what my big brain is telling me about that trade. Hey, I like this trade. It's oversold at this. They should be a lot of long calls here coming in, such and such. I would buy this, but maybe not go for such a big target, because it would probably run out of steam. Like, imagine what that would be like every single day, 5 days a week, to kind of have that feedback on your trades. And
Yeah,
so
I need
that's
it.
what we do in the Benzinga Option School is we talk about flows and we give feedback to students real time on their trades. And it's just awesome. It's such a fun experience. And you get to see me wear a ridiculous hat like this.
I know. I might need to get one of those. I might need to hop on there with you at some point. But so Chris, I mean, right now, how are you? I mean, are you trading yourself? Are you busy with the option school? I mean, how are you trading the markets?
Yeah. So I'm kind of mixing it up right now. With the market being heavily involved in day trading, particularly the S&P 500, I want to be day trading as well. If institutions are coming in and then coming out real quick, I want to take advantage of that. So I myself am personally doing a fair amount of day trading. Hold it for me at 30 minutes, an hour, 2 hours or something like that and be out of it. Those quick moves in SPY. In terms of swing trading right now, I'm leaning towards short term because the market hasn't quite found a footing yet. But I'm trying to position myself and the Benzinga Option School students to focus away from tickers that are going to be more impacted by rates. Tech is asymmetrically, impacted by rates. So we're not really trading a whole lot of tech right now. We like healthcare right now. We think that's great. If you want to be bearish, we like being bearish short-term on energy, being bearish short-term on financials right now. We think there's some opportunities in Hershey and Coin and Costco and things like that. We day trade, tech, but we're not swing trading tech because we feel like in this environment, traders and investors are not really willing to commit a whole lot to tech. So neither should we. Let's move where the flows are. Let's kind of position ourselves away from things that are not so influenced on tech. And then let's just keep an eye on the bond and yield space. And, when that starts to subside, then we'll start shifting more to, getting some bullish positions.
Yep. Well, I love it. I mean, it's a volatile market. We've got a choppy market. Like you said, institutions coming in, coming out. You've got to be nimble in these markets right now. So if you're, looking to learn more, you're looking for some help, look no further than Chris, look no further than the Benzinga Option School. So Mr. Chris Capre, thank you again for hopping on with us today. It was fun to get you back on the stream. We got to do it again some point soon.
That was a pleasure. Thanks for having me, and we'll hopefully see you in the near future.
Let's do it. All right, guys, smash the like for Chris Capre. I'll drop the link to the Benzinga Option School in there if you want to check out more from that as well. That'll do it for us today on Benzinga Live. Please smash the like if you have not already. We'll be back. I'll be back live tomorrow morning on Pre-Market Prep. Not going to be doing a Benzinga Live tomorrow afternoon, but in the morning I'll again be live on the stream for Pre-Market Prep. So excited for that. Make sure to tune in. Until next time, y'all, please smash the like again, subscribe to the channel. I'll drop my Twitter in the chat as well.